journal entries for various dividend types of transactions. We have Carlian Company listed the following items on its December 31st, 2018 financial statements. Investment in Man Company bonds, $25,000, dividends payable preferred, dividends payable common, preferred stock, 8% $100 par, common stock, $10 par, additional paid-in capital on the preferred and the common, and retained earnings. And then we have during 2019, the following transactions occurred. And they give us these different dates and transactions and ask us to prepare the journal entries. So we'll go ahead and do that starting down here. So we have February 2nd. We paid the semi-annual dividends declared on December 15th, 2018. So if we look up at this information, there's dividends payable of $4,000 to preferred and $40,000 to common. And so now we're actually at the date of paying that dividend that's already been declared. So we will debit the dividends payable for both preferred and common. And we're going to be crediting cash because that's what we're paying them with. And I'll just cell reference up here. The preferred was $4,000. Common was $40,000, which would give us $44,000 of cash. Then March 5th, we declared a property dividend payable to common shareholders on April 5th in Man Company bonds being held to maturity. The bonds, which have a book value of $25,000, have a current market value of $31,000. If we come back up to this original information, we see that book value of $25,000, but because they have a current market value of $31,000, we have to show the gain on the disposal of the investment from the 25 up to that 31. So we'll do that first by debiting investment in Man Company bonds and crediting gain on the disposal. And so that would be the difference of our $31,000 minus the book value of $25 to give us $6,000. So now that we've brought this investment account up to the current $31,000, we can now do the transaction showing that we're going to distribute these. And so we will debit retained earnings and we'll be crediting our property dividends payable. And this will be for the full $31,000. That's the current market value of the bonds. So now on April 5th, we actually pay the property dividend. And so if you remember from the chapter, it points out that we have the date where we have to identify the liability, and really this payable isn't necessarily a liability in the terms of how we classify assets and liabilities and equity, but it's an obligation to pay that dividend. And so now on April 5th, we actually are paying it, and so we're going to debit this property dividends payable, and we'll be crediting the investment in the bonds for that same $31,000. Now we have July 6th. We declared a $4 per share semi-annual cash dividend on preferred stock and a $1.10 per share semi-annual dividend on common stock to be paid on August 16th. So if we come up here, we can just quickly figure out how many shares there are, because if there's 100,000 of preferred stock and it has $100 par, we know that there's 1,000 shares And we can do the same thing of the common. 400,000 divided by 10 gives us 40,000. So now on July 16th, we're going to be debiting retained earnings and crediting our dividends payable preferred and our dividends payable common. And so we'll do the math on each of those and then sum that into the retained earnings. So the dividends payable for the preferred was a $4 per share, so 4 times our 1,000 shares. The common stock was $1.10 times our 40,000 shares. So we have 48,000 of retained earnings debit. Now on 8/17, we are actually paying the cash dividends. And so this will look very similar to the transaction from February 2nd. Except obviously our preferred is going to be this 4,000, common stock the 44, and the cash 48. Then we have October 15th, declared a 2% stock dividend on common stock to be issued on December 3rd. The current market price is $22 per share. So on October 15th, we're going to be debiting retained earnings. We're going to be crediting common stock to be distributed, and that'll be calculated at par. And then we're also going to have the APIC from stock dividend for that excess because they're telling us the market price is $22 per share. So let's do this retained earnings total. We can do that one first. It would be equal to the 40,000 shares times our 2% times 22 per share. And we get the 17,600. And now the common stock would be the 40,000 times our 10 times the 2%. And the APIC would be the difference, or it would be our 40,000 times the 2% times 22 minus the 10 because of the market price being 22 and the par being 10. And we get 9,600, and of course if we added these together we'll get that same 17,600. Okay, then on December 3rd we issued the stock dividend. So our debit will be this common stock to be distributed, and the credit will be actually common stock for the 8,000. And we only have to do that 8,000 because this 9,600 has already been dealt with in our additional paid in capital account. So then on December 28th, we declared a $4 and $1.20 per share semi-annual cash dividend on preferred and common stock respectively to be paid February 15th, 2020. So we can copy down our July 26th accounts because they're going to be the same, just we have to recalculate the numbers, but the retained earnings and the dividends payable still apply. And so this preferred is going to be equal to the 1,000 times our 4 that they identified here. And then the common stock, we have to be careful because we just distributed in this previous transaction a common stock dividend. And so we have to include that. We can't use just the 40,000. We also have to include the number of shares that were distributed here. So obviously we could just say that 8,000 divided by the $10 par means another 800 shares have been distributed. So for the common stock, we can say it's equal to, we'll just use parentheses here and say, oops, this 800 plus the 40,000, and then multiply it by the 120. And then when we add those together, we have total retained earnings being debited for $52,960.